Earnings Call Insights Opendoor Technologies Inc. Open Q2 2025 Management View. CEO Carrie Wheeler highlighted a pivotal strategic shift. We are now making the most important strategic shift in our history, moving from a single product to a distributed platform with multiple offerings delivered through agents. Wheeler explained that Opendoor is leveraging its proprietary data and AI to expand beyond cash offers, now providing sellers with options including cash offers, market listings, or a hybrid product called Cash Plus. She stated, "We began piloting this new approach in select markets last quarter. The early proof points were compelling. 2x more customers are reaching a final underwritten cash offer relative to our traditional flow. We're delivering offers faster with streamlined in-home agent assessments. Listing conversion rates on a 5 times higher, and we're unlocking more capital-light earnings through our share of listing commissions," Wheeler announced. On the strength of these results, we've gone from pilot to full rollout in record time. Today, partner agents are live in every market we operate. CFO Salim Freha stated, "At $1.6 billion in revenue, we achieved our first quarter of adjusted EBITDA profitability in 3 years." Freha pointed to deliberate choices, such as increased marketing spend and widening offer spreads, as drivers of results. He added, "Contribution profit was $69 million in the second quarter, representing a contribution margin of 4.4%. This was down from $95 million and 6.3% in Q2 2024. Driven by a higher mix of older inventory in our Q2 resale cohorts. Adjusted EBITDA was $23 million in the second quarter compared to a loss of $5 million in Q2 2024. Freha discussed balance sheet management, mentioning the issuance of $325 million in convertible senior notes and an ending quarter inventory of 4,538 homes worth $1.5 billion. Outlook. Freha shared, "Our guidance for the third quarter of 2025 includes the following: approximately 1,200 homes acquired, revenue between $800 million and $875 million, contribution margin of 2.8% to 3.3%, adjusted EBITDA between negative $28 million and negative $21 million, and stock-based compensation expense between $10 million and $12 million. He commented, "We expect Q4 revenue to decline sequentially at a similar level to the Q3 sequential decline. Contribution margin will also be pressured in the second half by an unfavorable mix of older, lower-margin homes given lower acquisition volumes, likely putting our goal of year-on-year contribution margin improvement out of reach." Financial results. Opendoor delivered $1.6 billion in Q2 revenue, with contribution profit at $69 million and adjusted EBITDA at $23 million. The company ended the quarter holding $1.5 billion in net inventory and $789 million in unrestricted cash. Freha reported, "We purchased 1,757 homes in the second quarter, slightly ahead of our expectations, but down year over year, driven by meaningfully wider spreads and accompanying reduced marketing spend. The company extended debt maturities and added $75 million in cash through a convertible note issuance. Total capital at quarter end stood at $1.1 billion. Non-recourse asset-backed borrowing capacity was $7.8 billion. Q&A. Day-K Lee. JP Morgan asked about macro stability and the timeline for new initiatives to impact results. Freha responded, "At the current moment, things seem to have stabilized, definitely well below where things were at the beginning of Q2. Our outlook for both Q3 and Q4 assume that we stay at or around this sort of overall macro environment." Wheeler added the impact of new initiatives would show up in conversion and in contracts long before we see it hit the P&L. With substantial P&L impact expected in 2026, Day-K Lee. JP Morgan queried on contribution margin profile of new products. Freha explained, "Cash Plus enables us to have more confidence in being able to deliver within our target contribution margin range. It's a better risk-adjusted process. The initial cash outlay is lower than it would be otherwise for a normal cash offer." Unidentified analyst, KBW sought clarity on Q4 revenue guidance and OpEx trends. Freha clarified, That's sequential on a percentage basis, not on a dollar basis. We would expect OpEx to ramp back up in Q4 and Q1, driven by marketing. Wayne Trin, Citigroup, asked about distributed platform performance and economics. Wheeler described twice as many customers getting through our funnel all the way to a final underwriting than we had seen historically on our traditional direct-to-consumer flow. We're seeing 5 times more people convert to a listing than otherwise we would have been able to monetize a lead into. Nick McAndrew, Zelman & Associates, inquired about pricing cushion and capital raises. Freja detailed, "We strive to set price to enable us to deliver within our target contribution margin range. The positive home price appreciation period of time this year was actually the shortest that it has been in quite a number of years. On capital, as for the ATM, no, we have not used it yet. We have 1.5 years remaining to use it, and will be opportunistic in how we leverage it." Sentiment analysis, analysts expressed neutral to slightly negative sentiment, focusing on macro pressures, platform transition timelines, margin sustainability, and expense trends. Management remained confident in prepared remarks, emphasizing the strategic shift and rollout speed. During Q&A, the tone was measured, with frequent clarifications and acknowledgments of macro headwinds. Wheeler said, "Our near-term outlook, however, does not reflect what we're building towards durability, relevance, and scale for the next decade." Compared to the previous quarter, analyst tone remained cautious around macro and execution risks, while management showed increased confidence in the new platform but tempered near-term expectations. Quarter-over-quarter comparison. The current quarter marks a completed nationwide rollout of the agent-distributed platform, compared to the prior quarter's ongoing pilot phase. Revenue increased from $1.2 billion to $1.6 billion sequentially, but acquisition volumes fell from 3,609 homes to 1,757 homes, reflecting macro caution and wider spreads. Contribution margin declined from 4.7% in Q1 to 4.4% in Q2, with management attributing this to older inventory mix. Adjusted EBITDA swung from a loss of $30 million in Q1 to a profit of $23 million, signaling improved cost leverage. Management tone shifted from emphasizing cost discipline and pilot expansion to highlighting broad platform rollout and the path to long-term scalability. Analyst questions in both quarters focused on margin sustainability, acquisition pacing, and agent channel economics. But this quarter saw heightened scrutiny of revenue outlook and timing for new initiatives to impact P&L risks and concerns. Management cited ongoing macro headwinds, including persistently high mortgage rates and lower clearance and record delistings. Guidance reflects expectations of pressured contribution margin in H2 2025 due to unfavorable inventory mix and lower acquisition volumes. Wheeler addressed the risk of delayed revenue impact from the new platform, noting material P&L benefits would likely emerge. In 2026, Analyst Questions probed the risk of home price volatility, margin compression, and the sustainability of cost controls. Final takeaway. Opendoor is executing a major strategic pivot with the full rollout of its agent-distributed platform and hybrid product suite, signaling a move toward capital-light, higher-margin revenue streams. While near-term financial results will reflect macro-driven headwinds and lower volumes, management remains focused on scaling the new platform, optimizing agent engagement, and building toward durable growth and profitability in the years ahead.